Listen guys, I cannot count on two hands how many of my rental real estate clients have suspended passive losses. I'm talking about thousands of dollars in suspended passive losses. The issue wasn't necessarily the fact that my clients had thousands of dollars in those losses, but mainly the fact that they didn't know they had them. They were accumulating year over year, which means they also had no plan for them. At this point, throw the whole property away. Okay, not really. Suspended passive losses aren't necessarily bad if you have a plan for them. In fact, some investors get into rental real estate to create these losses, but they usually have a plan for them. Most of the time, your tax professional gives you a high-level overview of your tax return. They don't review balances such as suspended passive losses to be carried forward to the next tax year. If they do, your tax professional is a diamond in the rough. My name is Sierra Stanberry. I help small businesses make smarter decisions today to build lasting wealth tomorrow. I saw a lack of understanding of suspended passive losses amongst my clients, so I decided to help each and every one of you understand this. In this video, I will go over what suspended passive losses are, provide strategies to untrap those losses, provide a preventive strategy so that you won't have these types of losses and can offset your active income, such as W-2 income. That's right, W-2 income. Last but not least, I will show you exactly where you can find out whether you have suspended passive losses or not. Let's get into it. 9 times out of 10, if you have a rental property, you are considered participating in passive activity. The income and losses from your property are considered passive. Passive means being able to generate income with little to no work within your business. Now, there are 2 types of activities that can be passive. Those are trade or business or rental real estate. Some examples of passive activity could be renting property, providing pre-recorded online courses, or developing an app. For the sake of this video, we will focus on rental property. Okay, so not only could you more than likely be considered passive in your rental real estate, but you may have suspended passive losses and have no idea. Suspended passive losses are essentially the same thing as passive losses. The only difference is the timing of when you can utilize the losses. Passive losses are considered suspended when they are unable to be utilized during the current tax year to offset your taxable income. When they aren't able to be utilized, they are then suspended and carried forward to the following tax year. Let's use a glass of water to represent how suspended passive losses work. The glass itself can represent any other passive income you may have besides rental income. The water being poured into the glass is passive income from your rental properties. Once the water reaches the top of the glass, it starts to overflow. All of the overflow water is considered suspended passive losses and flows to the next year to offset any other passive income you may have during that year. Note that the losses cannot be carried back to previous tax years, only forward indefinitely. Also, if you have a rental property or are planning to purchase one in the future, take note that it's not unusual to have these losses on your tax return. More than likely, if you are in the rental real estate business, your income is considered passive. However, the determination of how the income and losses from this activity will be treated for tax purposes is based on your involvement with the rental properties. All right guys, now that we know what suspended passive losses are, let's go over the good stuff, which is strategies to untrap your suspended losses. The first strategy is to sell your rental property. That's right, sell it. Selling your rental property at a gain will allow you to activate suspended passive losses regardless of whether you sold one or all of your properties. As long as your gain on the sale equals or exceeds your passive losses or suspended losses, you could possibly use those losses to offset your gain from selling the rental property. The IRS states, generally, you may deduct in full any previously disallowed passive activity loss in the year you dispose of your entire interest in the activity. This means that when you sell your rental property, you no longer have to treat those losses as passive. However, in order for this to hold true, the rental property has to meet 3 requirements. First, your interest in its entirety must not be present once the property is sold, meaning you can't have any more ties to the property, such as still profiting from or managing the property. Second, your sale must create a taxable event, which means the sale must create taxes owed to the government. Lastly, your sale has to be to an unrelated party, which means you can't sell to someone such as your parents. As mentioned before, when making the decision to sell your rental property, you want to make sure you have a plan for that gain. If you don't, your tax liability may be tremendous. But most importantly, guys, you want to make sure you have a good reason to sell the rental property. A good reason to sell would be terrible cash flow due to your rental property's location. You will need to dig into your opportunity costs before deciding to sell. Opportunity costs are benefits that you may miss out on when choosing another alternative. Opportunity costs are real and we want to consider them. Okay, so what if you have a rental property that is getting foreclosed on instead of being sold? This will activate the suspended passive losses from that property as well. You can use those losses to offset your active or ordinary income. Alright guys, so selling your rental real estate is one way you can untrap your suspended passive losses. Since selling is an option to untrap those losses, it's only right that I mention buying better real estate deals. Let me take you to the Real Estate Classification 101 class. Sit tight, I'm going somewhere with this. If you don't know, real estate has classifications. They can be Class A, B, or C properties. Class A properties are luxury properties with high rents in a good location. Class B properties are functional properties with average rents and could be in a good location. Class C properties are very old and are located in less desirable areas. Now, you will want to go for B and C properties located within A or B areas. Let's crack the code. In simple terms, this means buying older homes in nice locations. These properties will more than likely need rehabbing. However, these properties can create a passive loss within the tax year and generate enough gains in the following years to consistently offset the suspended losses. This is the type of property you will want to keep for the foreseeable future. I am in no way, shape, form saying this increases your chances of having a successful rental property. But I am saying this may help you acquire a rental property that consistently brings in cash flow. As stated by Benjamin Franklin, nothing is certain except death and taxes. Oh, before I move on to the next strategy, what if you don't have the money to buy another rental property, but you love real estate and still have cash on hand to invest? You could invest in syndications. Syndications are where multiple investors put money together to purchase or make a single investment. Depending on your situation, you will need to decide if you want to be a direct or indirect investor and then choose your syndication. For this strategy to work with suspended passive losses, you will want to be an indirect investor. This means you're just passing your money along and your work is done. Syndications can be great. The hold periods are usually less than 5 years, which means in 5 years or less, you can liquidate your cash, then use your suspended losses to offset that cash to make it tax-free. Now, do you see why I say you have to plan for suspended passive losses? Having money tied up for a while should be planned and not spontaneous. In addition, syndications can be great because they could create passive losses for a year or two. And if the cards are played right, they can create an insane amount of cash flow in future years. Once the syndication is sold, you can use your suspended passive losses to make some of your gain tax-free. So let's say your purchase price is $200K, your sale price is $250K, your passive losses are $3K, and your suspended passive losses are $15K. I would like to add depreciation recapture and adjusted cost basis play a part in this, but for the simplicity of this video, we will just use the facts mentioned above. Okay, so you would take your sale price of $250K and subtract your purchase price of $200K, which gives you a $50K gain. This is where passive losses come into play. You will need to account for the passive losses and suspended passive losses respectively. You would take the $50,000 gain and subtract the $3,000 passive loss and the $15,000 suspended passive loss, which leaves you with a taxable gain of $32,000. This means $18,000 of that gain is tax-free. The last strategy I will go over today to untrap suspended passive losses is investing in a business. It does not have to be real estate. All that matters is that the income is passive. Let's say you decide to invest in your friend's LLC because you believed in it. There are 2 requirements that need to be met to make sure this will offset your suspended passive losses. You have to make sure you do not participate in your friend's business operations, and you should have an equity stake in that business. You have to make sure the investment is within an LLC or an S corporation and not a C corporation. Let me tell you why. C corporations issue payments to investors as dividends, which are considered portfolio income. Portfolio income is not considered passive income and cannot be offset by passive losses. If you can get an equity stake in an already profitable small business, that will be perfecto. Keep in mind that small businesses can be a lot riskier than big businesses because they aren't as stable. However, no business is guaranteed a profit every year. Just make sure you do your due diligence by doing a background check and credit check on the business owner if you don't know them personally. Okay, so what are the best ways to find business deals? Good networking and business brokers. I'm sure you can find plenty of good networking events. Take a flight to a conference or something. Why not? It's tax deductible. Business organizations and trade associations are great ways to find a business broker. Business brokers often call these types of investment PIGs, which stands for passive income generators. If you don't have any other passive income to offset your rental property income, you may want to ask if there is a way to prevent passive losses so they don't have the chance to be suspended. If there's a will, there's a way. You need to find a way to qualify for real estate professional status. This will allow you to bypass all of the passive activity rules and write off your passive losses immediately. Now let me be honest. You have to be careful with this. I have many clients come to me asking how can they achieve real estate professional status for tax purposes. They usually can't because they are working a full-time job for an employer. If you are working full-time, it's so hard for you to prove that you have achieved real estate professional status. However, if you are married and filing jointly and your spouse is a stay-at-home spouse, it's time to make your spouse responsible for rental property management. Unfortunately for your spouse, but fortunately for you, your spouse will need to transition from the couch or whatever they do on a day-to-day basis to managing the rental properties. Pulling off real estate professional status will allow you to use your passive losses and bypass any passive activity rules. You can still work your full-time job and use the passive losses against your W-2 income. Okay, so what does it take to achieve real estate professional status for tax purposes? I got you. On a high level, you will need to have been managing your rental properties for 750 hours minimum per year, and you will need to be materially participating, which is a minimum of 500 hours. The focus of this video is on strategies to unlock suspended passive losses, so I won't get too deep into the details of how to qualify for real estate professional status. That calls for another video, so don't forget to hit the notification bell so you will know when I post a video. Also, please like, comment, and subscribe to let me know you like this video. Let's do a recap. We've gone over what suspended passive losses are and 3 ways to set them free, which were sell your rental property, buy better real estate deals, invest in a business. In addition, we went over a strategy to prevent passive losses from being suspended. One last thing before I go. How can you find out if you have suspended passive losses? You will need to check your individual tax return for Form 8582, Page 2, Part 7, which should be a section on unallowed losses. As always, this video is for informational purposes only and is not intended to provide tax or legal advice. Be sure to consult with your tax professional or accountant before engaging in any transactions. Thank you guys for watching. I'm Sierra Stanberry. I'll see you in the next video. Take care.